Hi, it's Paul Antonelli here with another episode in the Ideal Business podcast. Thanks for joining me today. My previous episode, I talked about risk, which is one of the criteria for determining how ideal your business is, and I went through potential sources for risk. What I'm going to do now is actually talk a little bit about what mechanisms you can put in place to manage and control risk. So it's fine to understand that there's things that can cause grief for your business, but it's good to know what you can do to control it and contain it. Obviously, the first one is insurances. Insurance is an entire risk industry. It is getting harder and harder, I think, to sort of get insurances for some particular areas. I know we've experienced that in some of our businesses in relation to that. But one of the best things to do in relation to insurances, and if you haven't done this, is get an experienced business broker. That's the only thing I can sort of suggest that you do in that area. We've done a few things in relation to risk management with insurances. The first thing is that we've lined everything up so all our insurances actually, because when you start a business, you get this and you get that policy in place, and you get this policy in place, and you get that policy in place, and you end up with all these policies all over the place. So a really good strategy is to have all your policies renew on the same date every year, and this gives you the ability to then do an annual review with your broker. So get an experienced, a really knowledgeable insurance broker. They're in the business of risk, so they can help you with this review of your business, identify areas, what is your insurance is available. I can't stress enough that a good insurance broker is worth their weight in gold, and it will save you tens of thousands, if not hundreds of thousands of dollars. I'll give you an example. So many examples where, we had a policy related to directors and officers, liability insurance. This is going back a few more years. We always maintain that policy. And part of that policy is it sort of covers breach of Trade Practices Act or misrepresentation. And we had a franchisee that was doing some very dodgy stuff in the business, and we ended up terminating him. Then he came back with a few other franchisees I think it was another two franchisees that he got together, and they sort of wanted to sort of have a bit of a legal approach to us. None of it was really valid. We'd done all the right things, but as I mentioned before, with legal processes, you have to deal with it. There's no option. And so that policy actually covered it. It was a $3,000 a year policy, and it covered that process, all the legal fees and the settlement payout, which was much more than the $3,000 that we pay on that annual premium. So, not having a broker, trying to manage it all yourself, it doesn't make sense. And having a broker that doesn't really know what they're doing or is substandard can potentially cost you thousands. So make sure you get yourself a good broker. It's really, really important. The second way that one of the things which is to manage risk is obviously having money or having access to money. So a second tip is to get money when you don't need it. Now, I don't know if you've ever been in a position in business where you've had to basically, you needed some extra cash, you had a cash flow squeeze or something going on. Whenever you try to get money when you actually need it from banking institutions, it's actually really hard to get. Typically, places, organisations, people that have money, they really want to give it to people that don't really need it. That reduces the risk. Because when there's a high need for the cash and the money, it can actually be too risky. So no one wants to really share your risk. So what typically happens is if I've got an issue in relation to some financial issue, I've got to pay something, or I've got a cash flow hole, no one wants to transfer that risk from your scene to their scene. That's not actually what they want to do. So I would really recommend that when all things are going well, your business is tracking well, you have got access to cash, then that's the time to go and get access to cash in place. So that could be an overdraft, it could be a business loan, it could be other funding sources. I've learned this so many times in business over the many decades. And so I just call it the just in case rainy day funds. So, I go back to my bank. I did that. It's been a few years back now where I changed banks and I wanted a whole bunch of facilities in place. And they actually came back to me and said, we don't seem to think that you need it. And I said, yeah, no, I will. I explained that I've got plans for expansion and this and that. But they were actually right. I didn't actually need the money. I didn't actually use it. So you don't have to. You pay a fee for that money, and depending on how you set the facility up. But it was just sort of that rainy day money. And so if you need access, if I've got access to it, I can, if I need it for some reason in short notice, and I can get access to it. So I guess it supports part of the policy that we have about building up cash reserves and access to cash. My approach is I like to have enough cash built up that I can run the business for 12 months, which gives you a fairly good buffer and the ability to handle most things that might come your way. So get money when you don't need it. That's another big tip. The other thing to utilise as an effective risk mitigation strategy is how you set up your business as a corporate structures. And look, you talk to your accountant about that. They'll give you, ideally you want to. The bottom line with structuring principles, and I'll talk a little bit about the way you should structure, is you just always, your trading entity, the business that engages with clients and suppliers, can get sued and can make mistakes and all that sort of stuff. Make sure that business, particularly at the level of for small and medium businesses, doesn't really own valuable assets or contain a lot of valuable assets. Because if something does go wrong, then you'll not only lose the business itself, but potentially anything that's it's attached to. And also what I've learned is when someone wants to embark on some legal action, and hopefully it doesn't take place, but and I've had this happen where it's not actually a bona fide legal action. We haven't actually done anything wrong. One of the first things that they tend to do is work out if it's worth pursuing that legal action. And at the end of the day, if there isn't anything in the box for them to gain, it does change their perspective. They're not like, okay, let's go for it. Let's spend $50,000 to see if we can get some money. Because if there's no money there to get, then it really undermines their motivation to actually drive a legal case. And you have to go through the legal process, but it's just something to keep in mind that legal fees are the biggest expenses in a legal process, relating to the settlement process as well. But that's something to consider. So with corporate structures, make sure that you separate. You do keep separate your assets and your trading. So trading, a lot of risk. Assets tend to have lower levels of risk depending on what sort of assets they are. And so we keep all our businesses run separate legal entities, and also we have a different way that we structure it. Another thing to consider within your business, and it depends on your sort of business, is to create a separate legal entity which holds your intellectual property, your IP. So, a lot of the time in business, it depends once again on the business that you're in, but a lot of the time, one of the most valuable things that you build up and can enable you to develop business and expand is your intellectual property. And so I'd always recommend that you look closely when you start a business, if you're going to do that, if IP is going to be a big part of it, and set up an entity which holds your intellectual property. And so anything that you develop over time actually sits in a different entity. And then you need to make sure it's, you do need some legal input into that to make sure it's all set up correctly, and you have commercial license agreements and a license fee between the different entities. And that enables you to, and it's sort of part of that other principle of separating the asset component, which the IP can be, from the trading entity. The third thing to consider is which is really important, is keep your personal structures and assets separate from the business. I mean, your business isn't you. Your business is a completely separate entity, which engages in commercial activity, which has a level of risk, which we've talked about. And so you may want to leverage your personal assets to raise capital, raise money, kick off a business. If you do that, you're making that conscious choice to do that, and potentially, using a second mortgage or existing equity. So I think it's important that you think about, if something went wrong, are you prepared with the outcomes? And I just want to say, look, I'm not a legal advisor or an accountant. So in relation to these areas, I'd suggest it's important that you get your own advice, talk to, both an accountant and a lawyer, because it's important to take into consideration your specific business, your assets, where you're at, and also your risk profile. So there's some ideas relating to, mechanisms to reduce and control risk in your business. And so if you look at your business at the moment and you scored your risk and you went, well, I'm not really comfortable with the risk profile at the moment. On the score of 0 to 10, you might say, look, it's sitting at around 5, and you might want to actually improve that score, from an ideal perspective. If that's the case, then have a bit of a look at those areas that I've just mentioned, and more than likely they may be able to assist you if you can do some restructuring in improving your level of, or the score that you have in relation to risk for your business, so that it becomes more ideal for you. And we, as business owners, we spend a lot of time building an asset and growing the base. What we do want to make sure is that we do get the reward at the other end, and we protect what we've built up over time. So thanks for joining the podcast. Hopefully that made some sense. I'll talk a little bit more about some of the key tools that you can look at utilising as well. And ciao for now.